So what's going on, everyone? So today I just want to quickly point out a few factors, a few metrics that are going to give option sellers that competitive edge, that are going to give sellers that advantage over option buyers. We have options. That's the thing I love about trading options. And it can seem complicated combining the options, into different strategies. But to make things simple, just think of the four options contracts. You have a long call, which are bearish, you're bullish. You have a short call, which are bearish. When you say short call, selling a call, long call, buying a call. You have a long put, which is bearish. You're buying a put. And then you have a short put, which is bullish. You're selling a put. So today's example, I'm going to walk you through a bullish strategy, but I'm gonna compare both ends of the spectrum. I'm going to compare if I were to buy a call versus selling a put, which are two bullish strategies. And the reason I'm using a bullish strategy is because I'm bullish in the Qs, and I'm going to show you a real live example of a broken wing butterfly, a bullish strategy where I'm going to eliminate my risks to the upside, and I'm just going to set a price target. So instead of me trying to chase a price, what I'm going to do is set a price target, and I'm just betting that the price of that stock is not going to hit, really more so ETF, is not going to hit that target that I'm pricing. The price, the price that I'm targeting. Okay. So like I said, I'm going to use the Qs as you see the Qs here. We're live. Obviously, the market is open. Now, the numbers that I am using for this example are pre-market numbers. So it was a one set number, but obviously now that the market is open, those numbers will be bouncing around. Like I said, we have the Qs here, and the Qs. It's an ETF. It tracks the NASDAQ 100 index, and it composes and it contains large international and U.S. companies in the U.S. In the technology sector, healthcare, industrial, consumer discretionary, and telecommunication sectors. The only thing that this excludes, it doesn't include, are financial companies. And some of the top holdings, some of the common big companies that it holds in this ETF is Apple, about 11%, Microsoft, Amazon, Facebook, both of Google's. You have your Class A and your Class C shares. You have Intel, Cisco, Comcast, and PepsiCo. Okay. Now I'm bullish on this sector because during these times of COVID and the pandemic, a lot of these larger companies, especially Amazon, specifically Amazon, are taking off. Man, they're still able to position themselves to still fill the void that's needed in the economy. And of course, Apple setting new record highs recently. Them just building the ecosystem. One of my favorite companies by far. They're just building the ecosystem for their customers to use their services, cloud and services and whatnot. So I want to show you why I'm bullish, and I'm going to show you the difference between buying a call and selling a put, and why you should always try to focus on selling options over buying options. Now, there are environments where it's better to buy an option, which will be low IV, low implied volatility environments. And in IV, implied volatility is just forward thinking. It's just the estimate on where that price may hit in the future. But go ahead, let's go ahead and jump into it. So what I'm going to do is go to the options chain here. Of course, you see your options chain on the left. You have your days, your calendar set out, the actual time of the year that the contracts are going to expire. And right here in the middle with the strike prices, where it says strike, it's going to give you the amount of days to expiration. On the right here, you have your implied volatility. This is just letting you know the possible range that the stock price can bounce around within that expiration cycle. So right now we do have the Qs trading at 260. Right now it's down about $2, which is going to be good in my opinion, which is going to be good for my bullish strategy, because that's going to give me an opportunity to sell in a weakness here. So what I'm going to do is I'm going to go 42 days out. Now the example that I do want to show, let's say we are bullish. Now before the market opened, it closed yesterday at 262. So the example I'm going to use is a 262 strike. Okay. Now, if we were bullish, your options trader, they would buy a call. So what they would do is they would go ahead and hit the ask on the 262. Right now, that premium, that debit paid, is $9.57. Like I said, I am going to be using pre-market numbers. The premium at that time was $10.31. So what this means is I'm going to pay, or an option buyer is going to pay. They would have paid $9.60 right now, but that 1031, they would have had to come out of pocket to pay a debit to lock in the right to manage or own or control 100 shares of the Qs at $262. So that option buyer is going to pay the option seller to lock in that price. Okay, now what does that mean for the option buyer? Okay, when we pay our debit, like I said, we're using the example of $10.31. This is a disadvantage that option buyers have, because when we pay our debit, obviously we're going to need the stock price to move to a certain point in order for us to get our debit back before we even see a profit. So the way you calculate your break even when buying an option, paying a debit, is you're going to add the premium that you paid, the debit that you paid, to your strike price. Okay, so in this case, the 262, which is the example that I used, right? $10.31 premium. Our break even price is $272.31. That's a 4% move that we need to happen, that needs to be necessary just for us to get our debit back. So anytime we're entering a position, we're long, we're buying an option, we need the stock price to move. Obviously, we're bullish, so we want the stock price to move. But what happens if it doesn't move? What happens if it stays sideways? What happens if it dips a little bit? So we're already putting ourselves at a disadvantage here. Our probability of profit is only 35%. Probability of profit is the chance or the probability of you at least making 1 penny during this contract, while this contract is open. And of course, going back to my last post where I was explaining theta. Theta is, of course, you're trading against time. So theta is the daily decay of the option's extrinsic value. And remember, I said option sellers benefit from theta, your short positions, because you have positive theta, and option buyers are at a disadvantage when it comes to theta because your long positions have negative theta. And you'll see down here at the bottom that negative theta. That negative theta is negative 11.85. So if you break that down into terms, your premium is going to lose $1.18 per day, no matter what. So you need the stock price to move. You're working against time. Your premium is losing $1.18 per day, no matter what. That value does change. It is static. It doesn't stay the same. But you already know you need the stock price to move as a buyer, and your premium is losing money every day, no matter what, as an options buyer. Okay. Not to mention IV rank, which is at 38 right now. You have IV at 34 in that cycle. It's a little on the high side. So this is letting you know that premium is a little bit more expensive. So why would I buy something that's expensive and risk the chance of those prices contracting, IV contracting? So I'm going to buy it higher so I won't be able to sell it higher later on because, cliche, buy low, sell high. So right here, you're buying high, but once IV contracts, those prices are going to decrease, and you're going to be able to, you're not going to be able to buy it back or sell it back. Excuse me. You're not going to be able to sell it back for a higher price for a profit. So you've already set yourself at a disadvantage with your break-even price, your probability of profit, theta, which is working against you, and IV is a little high. So premium is expensive. So you have 4 factors right now that are working against you because you bought a call, because you bought an options contract. How does that work if we were to just sell instead? We can still have the bullish assumption. We can still be bullish, right? But let's go ahead and see what happens if we were to sell a put. Selling a put is still a bullish strategy. Actually, I do want to show you the profit range here. So if we're buying a call, you see it's a bullish strategy. You see that gray area there that dictates your break even. Right here is where the stock price was currently trading, 262. And you see this gray area here. It needs to move to 272.31 to get that break even. Like I said, this is based off of the pre-market numbers, and I'm choosing the 262 price. But let's go ahead and see what happens if we were to sell a put and how we would increase our chances of winning by selling options over time. Same directional bias. We're bullish. Notice the gray area is behind you now. I'm going to explain why when you are selling options. So we're going to short the 262 strike here. But right now, a lot of things will change because now we're obligated. We're obligated to deliver shares. Now this here, I do recommend with amateur traders, you do learn spreads as soon as possible because you'll be properly hedged. A lot of amateur traders start out buying naked positions, buying calls, which are all naked. I will never understand. And I was there. But now that I'm starting to understand, more strategies, more spreads, you're actually helping yourself by understanding spreads because you're going to define your risk and you're going to leave more capital, more buying power on the table so you can get into other positions. Nonetheless, let's get back into why option sellers are going to benefit more over time than option buyers. Same directional bias. We're at the 262 strike. Pre-market, the premium we were collecting was $10.46. Remember, the debit paid was $10.31. To collect the break even when you're selling, what you're going to do is subtract the premium you collect from the strike price, because we're putting the premium we collect, we're putting that in our pocket directly. We have the money up front. So $10.46. Remember, we were at 262. That takes our break even down to $252. So we have $10 to the downside where we can still have money in our pockets from the premium we collected if the stock price goes against us. Now, I did put $9.46 because if the stock price goes down to 253, we still have $100 of our premium in our pocket. We still have the same directional bias. We want the stock price to increase, but we're profitable if the stock price decreases, stays the same, and increases, because like we said, we have that directional bias. Okay. Our probability of profit is 63%. Our theta, we're going to collect this. Remember, on the buying side, if we're buying, we're losing that no matter what. So who does it go to? It goes to the option seller. So now that we're on the side of time, our premium is actually going to lose this value every day. We want this to lose value because as a seller, you want to sell high and you want to buy it back at the cheaper price. So when you're selling, you want your premium to decrease. When you're buying, you want your premium to increase. So with our break even, we have some cushion to the downside. Our probability of profit is 63%. We have theta on our side, and we want this to expire out of the money, which is going to be full of extrinsic value. So we have all of that on our side over an option buyer. What does that look like with a full trade? Now, what I'm not going to do a simple, just one leg, one contract trade here in the Qs, but I wanted to point that out to you. And that those are huge differences when it comes to buying options versus selling options. When you buy options, you have a lower probability of profit. Time is working against you, which is theta. You need the stock price to move to wherever your break even point is before you even make a penny. I don't see why a lot of people are still buying options. And with IV being so high, with premium, with prices being so expensive, you need to hop on board and start selling options. You're going to win more over time. I'm not saying you're going to win it all. You're going to win more over time. You're going to put theta on your side. Time decay is going to be on your side. You don't have to worry about the stock price moving. The stock price can even go lower and you'll still be in a good position. Okay. Nonetheless, let me go ahead and show you what my bullish strategy is going to be. It's going to be a broken wing butterfly in the Qs. Okay. One thing that I do love about the Tastyworks platform, I don't have to add all of these contracts if I'm trying to do a broken wing butterfly. And I have to add one contract to this here, but all I'm going to simply do is, you see the strategy tab up here? I want a long put butterfly. Now I know you said, hey, what happened? You say you long, you're paying a debit. Right now it's routed for debit, but once I start adjusting my strikes, I'm going to be able to route that for credit. So this is going to be considered a short put broken wing butterfly. Right now, this is a long put butterfly. It's not broken. What makes it broken is me breaking the wings like this here. So right now it's trading at 260. It's down about $1. IV is a little on the high side, which is why I'm fine with selling premium. And one thing I want you to notice, let me put this back here. So you see, let's see here. You see how this is routed for a debit here? Because it's not a broken, we didn't break the wings. Now that we break it, you see how it turns into a credit. So that's going to give me my short position there. Okay. I'm going to actually roll this down a little closer. You see, we have all this open interest here. We have all this volume. You see this brown bar here? This gives us that IV range from the lowest to the highest. So the range of where the stock price is going to hit within 42 days. So what I'm going to do is I'm going to go slightly closer to it. Whereas, let's see here. So I'm just going to adjust these strikes here. So let's say if I cut my strikes here, I'm just betting that the stock price is not going to go to 250 within the next 42 days. I'm just setting a price target. I'm not chasing a price or anything, right? That gives me a 66% probability of profit. I'm collecting theta. Remember, I'm selling. So time decay is going to be on my side. Okay. I'm eliminating all of my risks to the upside because it's a bullish strategy. And I'm also collecting the credit. I'm hedged. So if anything would happen, if it would go against me, if I were to be assigned, I still would have a loss because there's a difference between my strike prices and I would have to cover that difference. But I'm hedged here. My risk is eliminated to the upside because it's bullish and I'm capped to the downside. a win-win situation. I'm going to actually adjust these just slightly more because I want to go, actually, I want to set my short strike at the 30 delta. Remember when we were referring to delta, how you can use that as a gauge of, your probabilities of being in the money. Now, when you're buying, you're long, you want it to expire in the money. But now that we're selling, we're collecting a credit, we want it to expire out of the money. So this lets us know, this 30 delta lets us know that this is a 30% chance of it expiring in the money, which means I have a 70% chance of this here expiring out of the money, which I love. And I'm actually satisfied with this here. I'm routed for a credit, 68% chance probability of profit. I'm actually fine with this here. What I'm gonna do is I'm gonna go fishing. I'm gonna try to collect a little bit more premium. And if I can collect it, why not? Let's go ahead and route that. And hopefully we can get filled on this. What I'm gonna do is I'm gonna try to reroute it again. Let's see where at. Let's go with the mid price here. Oh, the mid price is bouncing all over the place, as you can see. Okay, I could probably, let's get that one more time. Let's try to collect the higher credit. Let's go 21 since it bounced to 21. We'll let that sit for a minute. But this is the importance of knowing the difference between buying versus selling options, because you're gonna put yourself in a better position over time to win more. Okay, this here is my SPY position from yesterday. Bearish. My deltas are negative, so this was a bearish position. I'm betting within the next 42 days that the S&P is not going to hit $328. Okay, and I'm looking to take off this here once I collect about 50% of my premium. These strategies are a little bit more advanced. I don't want to get too complicated here, but I just wanted to really point out the difference between buying versus selling options and who has that competitive edge, who benefits more over time when it comes to trading options. And as you see in the numbers, sellers definitely benefit more than buyers. I appreciate all the questions that you've been shooting my way. Let me know what other questions you have. Thank you for your time. Thank you for your support. Don't forget to subscribe. Don't forget to share. Thank you for your time. Have a good one.